For nearly 15 years, investing was basically on easy mode. All you had to do was buy the index, walk away, and you'd make money. But that game is over. What we're seeing in 2026, it isn't just another market cycle. No, this is a real structural break. The S&P 500 is sitting at a staggering 196% above its long-term trend line. That's a regression gap that just screams something fundamental has to give. So welcome to what we're calling the Great Dispersion.
Just look at this number for a second, 49.89. That's the peak the CBOE's Dispersion Index, or DSPX, hit last quarter. Now, in simple terms, this index measures the expected volatility of individual stocks relative to the overall index. And let me tell you, a reading this high is like a quantitative siren going off. It's the market's own math screaming at us that the futures of individual companies are radically decoupling from the market average.
That's right. The beta decade, that whole post-2008 world of zero interest rates and basically endless quantitative easing, it is definitively over. Beta is just the market's overall movement. For years, a rising tide of cheap money was lifting all the boats, so just owning the market was good enough. But that tide has gone out, and what's left behind is this deeply fractured K-shaped reality where the averages, well, they're now dangerously misleading. And that brings us right to the core paradox of 2026. The S&P 500 index has gone pretty much nowhere this year. It's flat. But if you look just beneath the deceptively calm surface, individual companies are seeing these historic swings in fortune. Some are soaring, but a lot of them are collapsing. So the real question is, what is pulling this market apart at the seams? To answer that, you have to look past the headline number and really dig into the market's internal structure. The evidence isn't in the index's level, it's in the decaying relationships between its 500 component stocks. The very fabric of the market has changed.
Okay, so let's get really precise about this word, dispersion. All it is the performance gap between the winners and the losers. For a decade, that gap is pretty narrow. Most stocks just kind of moved with the market beta. But now, that gap is a chasm. This is the new landscape. And successfully navigating it, finding returns based on skill, independent of the market, that's what we call alpha. And high dispersion, well, that's the raw material for alpha.
And here, right here, is the smoking gun from a quant's perspective. Pairwise correlation, which is just a measure of how closely any two stocks move together, has absolutely cratered to just 0.26. That's a multi-decade low. This means that idiosyncratic risk, the factors unique to a single company's business, is now completely overwhelming the macro forces that used to dominate. Good old-fashioned company-specific research is officially back in the driver's seat.
And this just brilliantly illustrates the real-world consequence. The main S&P 500 index, the one you hear about, which is dominated by a few mega-cap giants, it's down over 3% this year. But the equal-weighted version, where every single company gets the same vote, is actually positive. Think about that. The average stock is doing fine. It's the titans at the top that are distorting the entire picture.
So, what's the catalyst for this huge split? Well, it's artificial intelligence. But, and this is a big but, it's not the AI of 2024, which was all about hype and just rewarding any company that had AI exposure. No, we have now entered the brutal, unforgiving, show-me-the-money phase. The market is no longer pricing the dream, it is pricing the tangible return on investment.
This data right here says it all. It clearly maps out the new caste system in the corporate world. You've got the enablers, think infrastructure players. They're seeing a massive 450 basis point margin expansion. Then you have the adopters, companies actually using AI effectively, and they're getting a really healthy boost. But then you have the disrupted, whose business models are being eaten alive, with margins actually contracting. AI has become a fundamental filter for survival.
And you know what? We can pinpoint the exact moment the market really woke up. Back in February of 2026, the release of these advanced AI agent tools from Anthropic, it triggered a violent re-rating all across the software and services space. It was a massive wake-up call. Suddenly, the market started pricing in the very real risk that entire categories of knowledge work could be automated, instantly challenging the competitive moats of hundreds of companies.
And this disruption is creating this fascinating dynamic that we're calling the headcount paradox. You've got large, incumbent firms laying off up to 15% of their workforce, and they're using AI purely for margin defense, just to protect their legacy cash cows. At the exact same time, smaller, more agile firms are actually hiring. They're using AI as an offensive weapon to attack new markets and capture white space growth. And the market? It's rewarding the attackers and punishing the defenders.
Now, look, every time there's a huge technological shift like this, people start shouting bubble. It's almost a reflex. So it is absolutely critical to put this AI surge into its proper historical context. How does it really stack up against, say, the electrification boom of the 1920s or the dot-com mania of the 1990s?
And this table really reveals the crucial difference. I mean, sure, there are similarities in the transformational hype, but just look at that financing column. The booms of the 20s and 90s were fueled by speculative credit and margin debt. But today's AI revolution? It's being bankrolled by the colossal free cash flow of the most profitable companies in history. This is not some fragile credit-fueled bubble, it's a CapEx-driven industrial build-out. Which brings up a really fierce internal debate for us. On the one hand, you'd think AI should make markets more informationally efficient, right? Pricing in new data instantly. But what we're actually seeing is that this speed might be creating more volatility and these violent idiosyncratic price swings. I actually think it drives both. The market gets more efficient between events, but the reaction to a catalyst, like that Anthropic moment, is far more severe and instantaneous. And this paradox is exactly what creates the opportunity for active managers who can see these dislocations coming.
Exactly. And that opportunity, it's not going to be found debating the PE ratio of the top 7 megacaps for the 1,000th time. No way. The real alpha, the real variant perception, is now hidden in plain sight, in the rest of the S&P 500. It's in what we're now calling the other 493.
So the whole game is about finding these non-obvious winners. We're hunting for second-order beneficiaries. A company like AppLovin, for instance. They're not a chip maker, but they're using AI to automate the fiendishly complex world of mobile ad bidding, and it's driving explosive earnings. And you can't forget the physical world. This massive, unglamorous build-out of data centers, power grids, and cooling systems is creating some huge, durable winners.
So the entire investment framework has to evolve. The old model was just about buying a basket of stocks with AI exposure. The new model is all about identifying a selection edge. We're looking for those specific companies, often completely outside of the tech sector, where AI isn't just a line in a press release. It's a fundamental alteration of their cost structure and their entire competitive position. Okay, so let's bring all of this together. The data is conclusive. The end of the beta decade, the collapse in correlation, and this clear fundamental bifurcation driven by AI's ROI phase, it all points to one clear tactical conclusion for how to navigate 2026. And that conclusion is this: the index-only era has peaked. The idiosyncratic era has begun. The market is no longer a monolith that you can just passively buy. It's a complex ecosystem of individual stories, individual fundamentals, and increasingly, individual outcomes.
So, the case is pretty simple. First, a definitive regime shift has happened. High dispersion and low correlation are just the new normal. Second, this is all being driven by a fundamental bifurcation, where real-world AI profitability is separating the winners from the losers. And third, this new environment is absolutely tailor-made for skilled active management to prove its resilience, finding alpha by owning the true adopters and, yes, by betting against the companies that are being structurally disrupted.
Which really just leaves us with one final thought. We'd encourage you to take a hard look at your own strategy and ask this one critical question. In this new era of dispersion, is your portfolio still built to capture yesterday's beta, or is it positioned to actively go out and hunt for tomorrow's alpha?